In July, Melbourne's housing market performance once again lagged. While Sydney showed no significant improvement, it continued to experience slight increases. The three mid-sized cities, Brisbane, Adelaide, and Perth, continue to lead the Australian housing market with significant growth. The vacancy rates in Sydney and Melbourne CBD have rapidly increased, which seems strange in the booming rental market. Could international students and new immigrants have moved elsewhere, or is there another hidden reason? Australia's central bank, the RBA, decided not to raise interest rates this Tuesday. This indicates that the Australian property market might need to hold on for another 6 months before the expected rate cuts and a healthy market boom. In this episode, we'll analyze the trends in Australian housing market in July and discuss why Australia is delaying interest rate cuts. We'll also delve into the potential impact of a sharp decline in immigrant and international student numbers on property investors, ensuring you're well informed and prepared for any market changes. Hi, I'm Alex. Welcome to Oz Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. First, let's take a look at the trends in the Australian housing market for July 2024. Nationwide, the Australian housing market saw a 0.5% increase in July. This marks the 18th consecutive month of price increases during the current upward cycle. However, the rate of increase is gradually slowing down. Sydney also experienced an 18-month growth streak, but the growth rate in July dropped to 0.3%, which is 0.2% slower than in July. Over the past 9 months, although Sydney's housing prices have risen, the increase has been minimal, with monthly gains generally within 0.5%. Therefore, I put Sydney's housing market over the past 9 months in the flat category. Quiet property market in July in Sydney is normal when considering seasonal factors. June just marked the end of the financial year. July coincided with student holidays, and the cold weather contributed to the traditional housing market low season. Now let's look at Melbourne. In July, Melbourne's housing market fell by 0.4%, which is a surprise. Although Melbourne's monthly price changes have been within the range of plus minus 0.5% over the past 13 months, indicating a flat market, this drop is a bit significant, especially after a 3-month downward trend in May, June, and July. Brisbane saw its 17th consecutive month of increase, with a 1.1% rise in July, continuing its upward trend. Adelaide's price rose by 1.8% in a single month, and Perth once again set a record in Australia with a 2% increase in July. Over the past 4 months, Perth has maintained a 2% monthly increase in housing prices, showing no signs of slowing down. The Australian housing market can be divided into 3 major categories. Big cities, including Sydney and Melbourne, are in a flat market. Mid-sized cities, including Brisbane, Perth, and Adelaide, are in an upward market. Small cities, including Canberra, Hobart, and Darwin, are also in a flat market. Currently, Australian interest rates are at a 4-year high and have been so for a while, which is a strong tightening effect on credit. This tightening effect applies nationwide, and with inflation not yet coming down, people's ability to buy houses is declining. Under these circumstances, mid-sized cities can still achieve price increases. The only explanation is that more and more people are moving to those 3 cities, and the pace of new housing construction is not fast enough, leading to a mismatch between supply and demand. For those watching the Australian Property Strategy channel for the first time, I'd like to clarify that the market average measures the average increase or decrease in property prices and does not represent every property. The overall Australian housing market trends does not reflect the trends in every city, and similarly, the Sydney housing market trend does not represent the price movements in each suburb or for each house. The market trend only gives a general impression of the market. Individual properties still need specific analysis. The above were the monthly trends for each city's housing market. The best method to observe trends is to look at the 90-day trend chart, as extending the time frame to a quarter smooths out the fluctuations and makes the trends clear. From the 90-day trend chart, it's evident that mid-sized cities are in an upward trend, with Perth and Brisbane showing steady growth and Adelaide still accelerating. Conversely, looking at the big cities, Sydney is in a stable flat period with slow growth, but Melbourne's trend seems worrisome. The red line represents Melbourne, and we see the recent curve turning downward, showing the housing market declining faster for 3 consecutive months. We cannot yet determine if Melbourne has entered a downward cycle, as the monthly decline has not exceeded 0.5% range of the flat market. By the time we host this month's live broadcast in early September, we should have an answer. By the way, the 4 small green circles in the picture mark the points when I made market direction predictions over the past 3 years, which have all been correct so far. We're currently verifying the fifth prediction, and the results will be out in a few months. The national rental trends in July were similar to June, with the overall market rising across all cities and property types. Perth rental growth has slowed, while Canberra and Hobart's rents have accelerated. The rental yield, which is the gross annual rental income divided by the property price, is the worst in Sydney at only 3.1%. As all the rents are high, property prices relative to rent are even higher. Darwin has the highest rental yield in Australia at 6.5%. It's important to note that this is based on gross rent, resulting in gross rental yield. After deducting holding costs such as interest, property management fees, land tax, council rates, water rates, and maintenance fees, the net cash flow for most properties is currently negative due to the high interest rates. Even if fully paid in cash without a loan, the net return after expenses is only 1.5% to 3%. If the property doesn't appreciate or appreciates too slowly, it might be better to invest the money in a fixed-term deposit. We previously calculated that buying an investment property in Australia, if not using a loan, might be less advantageous than investing in other assets. Once leverage is added, provided there are no significant issues with the property, the ROI and stability far exceed those of other asset classes. Since February 2023, the Australian housing market has accumulatively increased by 13.5%. Over the past 3 months, the cities with cumulative declines include Melbourne down 0.9%, Hobart down 0.8%, and Darwin down 0.3%. The cities with cumulative increases include Perth up 6.2%, Adelaide up 5%, and Brisbane up 3.8%. We also observed that the price growth rate of high-end properties in the past 3 months was only 0.8%, while low-end properties was 3.3%, reflecting the trend that people cannot afford higher-priced properties. To avoid any misunderstanding, I must explain that, according to our research, high-end properties generally have a higher long-term appreciation than low-end properties. The current slow appreciation rate of high-end properties is just temporary. Although this pattern exists, the ultimate profit depends on various factors, such as the timing of purchase, the leverage used, the holding period, and the timing of sale, as well as tax considerations. Therefore, whether you make more money does not depend on whether you buy high-end or low-end properties, but on the combination of these variables, sometimes even involving a bit of luck. However, in most cases, following 3 principles, buy early, buy more, and don't sell, generally allows you to outperform the market average. In June, the decline in building approvals in Australia was quite significant. Residential property approvals dropped by a total of 6.5%, with approvals for houses decreasing by 0.5% and apartments by 19.7%. Of course, these figures are based on the absolute numbers for the month. However, looking at a more stable trend graph that excludes seasonal factors and considers a long period, the changes in approvals for houses and apartments are not substantial. There hasn't been a significant increase in approval numbers expected from the major developments in New South Wales, Victoria, and Queensland. This indicates that government support for new housing constructions is still insufficient, possibly because the actual implementation has just started and hasn't yet built strong momentum. In other words, achieving the government's goal of building a large number of houses, flooding the market with supply, causing house prices to drop, and making housing more affordable for more people will likely take at least 2 years to show some effect. After a noticeable acceleration in inflation in May, economists and columnists predicted that Australia would surely raise interest rates, with some forecasting 1 to 2 rate hikes. This caused widespread anxiety in July, reducing the desire to buy houses and increasing the willingness to sell. It indirectly led to an overall slump in the Australian housing market in July, particularly in Sydney and Melbourne. However, after the second quarter inflation data was released at the end of July, market sentiment quickly changed. The trimmed mean CPI for the second quarter was only 3.9%, slightly lower than the 4% in the first quarter. This relieved many people, and experts collectively shifted their views, believing that the likelihood of a rate hike was low. Let's take a look at what the RBA governor said.
So today, as you know, the board decided to leave the cash rate unchanged. For now, the board judges that the level of the cash rate is appropriate for balancing our inflation and employment objectives. And I want to highlight here that there is still a risk that inflation will take too long to return to target. A rate cut is not on the agenda in the near term, given what we know, but I should say that they are vigilant to the upside risks. If it does appear that inflation is not tracking the way we are forecasting, then they will, if needed, increase interest rates. It's really funny, actually. Over the last week, I've read commentators with absolute certainty that we must lower interest rates now. I've also heard commentators with absolute certainty that we must raise interest rates now. I wish I had their certainty.
I watched the entire 40-minute press conference by the governor. 2 points are worth noting. First, what does near term mean in the context of not cutting interest rates? A reporter specifically asked this question during the conference, and the governor's answer was typically ambiguous, without giving a precise time frame. My understanding is 6 months. Then I saw a financial columnist write an article titled, "Unless the world ends, the RBA won't cut rates before the end of 2024. High interest environment will persist." Second, the governor also mentioned during the press conference that she have reviewed the arguments for both raising and cutting interest rates. She essentially said, "Don't guess, even I don't know whether the next move will be a hike or a cut." Since taking office, the governor has been data-driven, reacting to the data she sees. This may lead to some delays, but it helps avoid mistakes. Currently, Australia's interest rate trend is opposite to that of G7 countries. If G7 countries continue to cut rates, especially if the US starts aggressive cuts in September, I think Australia won't be able to stand still. The US has seen significant drops in inflation and notable rises in unemployment, sending very clear signals for rate cuts. Of course, these are all speculations about the future and no one knows the answers. Recently, we observed a hidden market trend that many have yet to notice. Vacancy rates in the CBDs and within a 5-kilometer radius of Sydney, Melbourne, and Brisbane have started to rise, especially in Melbourne. 85% of Australia's international students live in these three cities. In the CBDs within a 5-kilometer radius, international students make up 25% of the population. The average vacancy rate in Melbourne is only 1.3%, indicating a very tight rental market. But within the CBD alone, the vacancy rate has quietly risen to 3.5%. What is the reason behind this phenomenon? It's due to the federal government's policy to reduce immigration, particularly targeting a reduction in the number of international students. On Monday, the federal parliament entered a discussion phase and may introduce a bill to cap the number of international students registered at universities to no more than 40%. If this law takes effect, it will directly impact the enrollment rates of the group of 8 universities. For instance, the University of Sydney will need to cut 12,150 international student spots, reducing the demand for 3,000 to 5,000 rental properties, mainly affecting the rental market near the CBD. This is just the impact of one university. The University of Melbourne will need to reduce 7,725 international student spots. Reducing the number of international students has now become a consensus between the two major political parties in Australia. The underlying logic is that Australians can't afford to buy or rent houses because of international students. To improve the lives of Australians, reducing the number of international students at all costs has become politically correct. With the federal election coming in May next year, this issue has become a part of the two parties' campaigns, with each trying to be tougher on international students. Therefore, I don't see a reversal in the trend of reducing the number of international students until the end of 2025, unless there's a black swan event. Imagine the impact this will have on the property market in the CBDs and within a 5-kilometer radius, especially on apartment rents and prices, over the next 2 years. I mentioned this back in 2022 when Australia first reopened its borders, and international students and immigrants flooded the rental market. Rents soared back then. But if these immigrants and students stop coming one day, will rents still rise? Many thought this was a fantasy back then, but it seems to be happening right now. So if you own or about to own an apartment near the CBD, it's time to make some adjustments to your investment portfolio. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye.